All right, everybody, welcome. This is the 2021 Eagle Fund update. Eagle Fund is a student-managed investment fund. It's been in existence for approximately 17 years right now. Behind me, I have five first of all, I've got Brandon Boba Ashurst right here. Wyatt Bromley, Andrew Cerrone, Nikunj Dalmia, Dave Shermer, and in the E-House, because he couldn't make it today, is Danny Veronov. And they're going to tell you about the Eagle Fund, what it is, how it's managed. And it's going to later they will tell you about any changes that have been made, and then finally kind of give you an update on its performance over the last year. So year plus, actually. All right, so let me turn it over to our first presenter. Hold on, thank you.
Do you need my company to grab it?
Yeah. You have to try to not be seen.
Yes.
All of human history, people have been
First off,
to be seen, and now
we're going to talk about what the Eagle Fund is.
Not to be seen.
Maybe. All right. So the Eagle Fund started from a $100,000 donation by the late Claire Sunderland. It's a student-managed brokerage account, and it gives us a once-in-a-lifetime opportunity to actually actively manage funds. And it's overseen by Dr. Bradley Andrew. And the idea behind the Eagle Fund is we can only take long positions in different asset classes like stocks, bonds, commodities, and real estate, but we can't buy derivatives and take a hedge position to guarantee returns. So first, we're going to talk about the efficient market hypothesis. It was developed by an American economist, Eugene Fama. So the theory basically says that prices will always reflect all the available information. And the result of this theory is that securities will never be mispriced, so holding the market portfolio is the best strategy. And according to evidence, the efficient market hypothesis actually largely holds true, but there's always going to be anomalies. Also, we like to take a diversification approach. So the idea behind diversification is holding securities with lower negative correlation. So you can diversify between strategies or asset classes, and it increases risk-adjusted returns over the long term.
So this is a new policy that was implemented for the first time this semester with the Eagle Fund. And ESG stands for environmental, social, and governance. So these are the three factors that are used to measure the sustainable and social impact of a company or business. For social, investors want to understand how does the company improve its social impact both within the company and in the broader community. For environmental, investors trying to understand what kind of impact does a company have on the environment. This includes like their carbon footprint, dumping of toxic chemicals, and other sustainability practices. For governance, investors trying to understand how does the company's board and management drive the positive change. This includes this includes issues around the executive pay, diversity in leadership roles, and interaction with shareholders. Because ethics are constantly changing, we have decided to institute a policy that allows every manager to have the ability to object to any investment decision and present their argument to the other managers. When considering investments, a vote will take place and the majority will decide whether or not to proceed. Not setting strict ethical guidelines at this point in time allows generational change in what is ethical to be more easily instituted when portfolio managers believe a business to be acting unethically. It also allows more opportunity for students to consider their own personal ethical beliefs in relation to the portfolio, rather than just referring to a concrete set of guidelines instituted by one class in 2021.
All right, so the Eagle Fund is allocated in 4 different strategies. So 13% of it is in a hedge strategy, 25% of it is in a buy and hold value strategy, 27% is in a momentum-based strategy, and 35% is in a buy and hold asset class strategy.
All right, good afternoon. I'm going to be talking about the buy and hold asset class. It is exactly what it sounds like. We buy assets and we hold them, regardless if they do well or if they do poorly. And then we readjust our allocation annually to what we want. So that means that at the beginning of this year in the bear market during January and February, thanks to our good friend COVID-19, we didn't stray away from the strategy. It's built for this. It's built for us to stay in it and look at the long term. And we only use, oh, you're good. I got it. We only use low-cost mutual funds and ETFs, exchange-traded funds, which are basically mutual funds that trade like stocks. And the conventional wisdom behind this is that you are investing in these low-cost mutual funds and ETFs. You just rebalance annually, you don't look at it besides that, and you're really only going to readjust to make your portfolio less risky as you work towards retirement. But luckily, Juniata, our students graduating, everyone here, are just getting replaced by more students, so we don't gotta worry about that. But it's really conventional wisdom because it works. Go ahead. All right, so this is what it's made up of. 43% equity, 36% bonds, 15% real estate, and 6% commodities. So the first thing I want to talk about in our equity allocation is in the orange, the EFA Minimum Volatility Factor ETF. EFA stands for European, Australasian, and Far East. We have this allocation in international stocks because we kind of think that the US stock market might be overvalued compared to the international stock markets being undervalued compared to profits. The US stock market has done really well over the last 12 years, has been trending up, but we think that the international market could do the same thing. Just below it, S&P Emerging Markets Low Volatility ETF. Now I want to focus on the low volatility, the minimum volatility. What we're going for here is lower risk. Historically, higher risk doesn't actually mean higher return. Over here on the left, we have small cap value index fund, a small cap index fund, and an S&P 500 equal weight, which means we're equally weighting at the top of the S&P 500 as well as the bottom. And all three of these work to basically undervalue the tech growth stocks that are kind of at the top, because we believe that in the future, even though they have overperformed in the last 12 years, that they will underperform in the future. And we're going to talk a little bit about that later as well in the presentation. Go ahead. Now to fixed income. I'm not going to read you everything that's up here. We have quite a variety of bond markets that we're into, intermediate and short term, as well as TIPS. TIPS are Treasury inflation protected securities, which basically try to match inflation. Basically, one of the safest investments you can make in real return, you're supposed to make zero because they're matching the real inflation. Bonds are part of our portfolio as a diversification to other holdings. Typically, they're not strongly correlated with the stock market. Go ahead. Onto real estate. It's about 50-50 domestic and international. 47% is in US real estate ETF, and then 53% is in ex-US, so everything outside of the US. We don't invest in real estate directly. We invest in real estate investment trusts or REITs that basically act as ETFs for the real estate market. And again, we invest in real estate because it diversifies against our other holdings. It's actually typically done better than stocks historically and also been less volatile in the past while also acting as a diversifier for us. And last, we have commodities. Commodities, again, are a great diversifier for us. Typically, they don't correlate at all with the bond market. They're very weakly positively correlated with other asset classes, so that is why we hold these as well. And I'm going to give it on to Dane to talk about the momentum strategy.
So the momentum strategy is the second largest kind of strategy that we use here at the Eagle Fund. And similar to its application in physics, momentum just talks about the tendency of an asset price trend to continue. So if an asset is doing well, then oftentimes it will continue to do well. And if it's doing poorly, then it will continue to do poorly. And there are kind of two types of momentum that I'm going to break down a little bit later, but those two types are absolute and relative momentum. And momentum strategies typically employ anywhere from a 3 to 12 month look back period. Here at the Eagle Fund, we decided on 200, which kind of is more or less splitting the difference. And we look at 9 different asset classes, which include emerging market equities, indexes for countries such as Europe, Japan, Australia, 10-year bonds, and real estate. So if we look at the next slide, we can look at the difference between absolute and relative momentum. So absolute momentum is basically if an asset class falls below the 200-day moving average, then we liquidate it into cash. And the idea behind this is that these assets are more volatile, and as Wyatt had mentioned, more volatile doesn't necessarily mean higher returns. So there's something that can negatively affect the outcome of the portfolio as a whole, so it's something that we choose to avoid when we can. And relative momentum is basically puts the asset classes against each other, and if an asset class is in the top 3 highest performing over the last 6 months, then we just buy and hold. And that's based on the principle that the asset class is doing well for a reason, and because it's doing well, it will continue to do well. So there are some critiques of momentum, and the most common of which is that it's chasing performance. But as many studies have shown, that is not the case at all. Momentum portfolios tend to outperform those that are based on market indices, and it's something that we choose to employ at the Eagle Fund for that reason. So right now, our momentum holdings are split kind of in 3, with small cap index, equal weight, and emerging market holdings as asset classes. So I will pass it on to Andrew for hedge.
This is the hedge portion of our portfolio. And hedge portions are typically designed to do well when the rest of the market is not doing well. Its allocation is currently set at 12.5%, but it is about 5 to 6% over allocation right now because of a large cash position in the portfolio. This was first implemented in 2017 because the portfolio management team at the time believed that US equities were overvalued, and they were worried that future returns would be low in the future. They decided to sell some of those equities and create this hedge strategy. The original hedge strategy included a tail risk ETF, inverse market ETF, preferred bank shares, those of Wells Fargo and Bank of America, as well as dividend ETF and cash. So one of the significant changes in this strategy in the last year or so is that we sold our dividend ETF that was called Divi. It didn't perform as we expected. It proved to be too well correlated to the market, and we thought it had some redundant exposure because of our preferred bank shares, which already pay high dividends. Funny enough, the ETF was actually delisted and liquidated not too long after we sold it, so I think a lot of investors came to a similar conclusion. The most recent addition to the portfolio and the strategy overall was the purchase of TVF. TVF is a ProShares product that I'll touch on in more detail soon, but we bought it to hedge against rising interest rates. So why do interest rates matter? Theoretically, the value of a company is equal to the present value of all its future cash flows. So future cash flows are discounted back to today at some rate. And when interest rates rise, so does the discount rate. And the value of the company is suddenly worth less. You know, it's a downward pressure on stock prices when interest rates rise. This affects all stocks, but the effect is more pronounced on growth stocks specifically. We hedged against rising interest rates with the addition of TBF, which is ProShares short 20-year treasury ETF. It uses derivatives and futures to provide inverse exposure to bonds, specifically long-term bonds. We're essentially going short bonds and long interest rates. Because the Eagle Fund has a large position in growth stocks, About 15% of our portfolio is in Apple, and about 5% of our portfolio is in a Vanguard Growth Index. So we're worried that if interest rates rise, we're going to see a underperformance from that part of the portfolio. And that's kind of what we've seen in the last 3 months or so, which has prompted this decision. And somewhat conveniently, it also protects against inflation. We're not making a bet about inflation, but given the current macro environment and all the government spending we've seen, it makes us feel a little bit better having this in the portfolio. Two other interesting parts of this strategy are the Cambria Risk ETF, or TAIL ETF, and the ProShares Short S&P 500 ETF, or SH. The first of these holds bonds and out-of-the-money put options on the S&P 500. The idea behind this is that stock market returns are not normally distributed. There's two fat tails, which basically means, there's an increased frequency in unexpected events, so high drawdowns. In order to protect against high drawdowns, it buys puts, which are stock options, a form of derivative, that perform well when the market doesn't. SH is designed to act as the inverse of the S&P 500. It's similar to TBF, but for stocks. So when US equity markets do well, this does the opposite, which is good. And we generally don't expect this part of the strategy to drive our returns. It's for events like in March when we saw the stock market crash to protect against large losses. And it actually did that during March. We saw significant returns and lower volatility than a simple market portfolio. So breaking down the overall allocation, we have 35% in cash, 24% in the new TBF, 16% in the Wells Fargo preferred shares, and 13% in the Bank of America preferred shares. Then 7% and 5% in the TAIL and SH ETF respectively. This is for Danny.
Hi, everyone. I hope that you can hear me both in Zoom and in the room. I'll be presenting about the value investing strategy that we have in the Eagles Fund. So the first slide, obviously you have the graph here, and I'm just going to explain a little bit about what the value investing strategy is. Value investing is a strategy in which we research particular companies that we believe are either undervalued on the stock market or just like the whole industry itself is depressed. These companies usually come from industries that are depressed and also overlooked. And our portfolio management team has a checklist of specific characteristics that we typically search for in order to implement the strategy properly. Could you switch the slide, please? Thank you. So the buy and hold value strategy has 25% of our portfolio, or takes up 25% of our portfolio. Where do we often look? We typically look at boring or oddball stocks, and we typically find those from looking at investing blogs, kind of listening to podcasts, discussing with BA, or typically just reading the news or kind of reputable sources or investors. The quantitative measures that we like to look for is the low P to E, so anything under 13, a low P to B, or price to book, which is close to 1, a low total deficit, a low P to FCF, which is lowest, typically around 20% of all stocks, and lower than 15, a low EV to EBITDA ratio, which is less than 10 for great businesses and less than 8 for good businesses, and a high inside ownership. And the qualitative measures that we typically want to look at are a high insider ownership, because typically when that happens, that the company has incentive for success and the leaders of the company actually want the company to succeed. And then you look for desirable compensation for the higher ups in the company. That would be stock options rather than cash. And then overlooked companies typically have something that's forgotten about them to the public eye, and that tends to drive them to a cheaper price. And the 5 questions that we ask is, does the company have a moat? So does it have a sustainable competitive advantage? Has Mr. Market created a margin of safety, which means that the market price is significantly below the intrinsic value, and it'll continue to be that way? Why is it cheap, and why does the market or does the market know what we don't? So typically we ask that when we're going over the company and we see if maybe we're missing out on something or if we're overlooking something. And then are the managers incentivized to align with the shareholders' values? So therefore, the company is kind of operating in both the shareholders' favor and the manager's favor. And lastly, does the company practice good capital allocation? And that's something that I'll go over in the next slide. So the 6 things that we say that we look at when we talk about capital allocation is, does the company issue dividends? Does it have any acquisitions? Does it buy back shares when the stock is below book value? Does it pay down debt? Is it reinvesting in the company, or is it doing nothing with the money and just holding on to cash? And then you can continue to the next slide, please. So recently we acquired, we purchased Polar Banknote. We purchased Polar Banknote, which is a PBL on the stock index. And this is a growing Canadian lottery and iLottery company, and it's overlooked in a boring industry. So basically this company operates with, or in the lottery and iLottery business, but the iLottery business has been awfully overlooked in the financials up until recently. And that's something that we wanted to take advantage of. And so we look at certain qualitative or quantitative measures first. So we looked at the P to E ratio, which is actually quite high. But then we looked at the company as a growth to reasonable price, which is the GARP ratio. And basically this is the ratio that combines the tenets of both growth investing and value investing. And we looked at this ratio because of the high P to E. And we knew that even though it has a high P to E, it's going to continue to grow as a company. And we looked at the insider ownership. So it's at 65%, which is very high for a company. And that typically means that the company, or that the owners of the company, or that the shareholders of the company know that there's going to be, or executives of the company know that there's going to be something positive that's going to happen in the future. So we also looked at the qualitative measures, which is the high insider ownership, the incredibly profitable and growing iLottery business for them, which is moving to the United States from Canada, and the favorable capital allocation. And then you can switch to the next slide, and then I'll hand it over to Nikunj for the acquires multiple.
Thanks, Danny. So the acquires multiple is a group value stock strategy. It focuses on buying companies that are cheap relative to their current operating earnings. So the strategy consists on holding 20 to 30 cheapest stocks. And we use the acquires multiple as a measure of cheapness, which is calculated by dividing the enterprise value of a company, which reflects the true price of a company by including their market cap, their debt and preferred stocks, and minority interest, by its EBITDA, which equals to their operating income with the interest, taxes, depreciation, and amortization added back. The lower the acquires multiple is, the cheaper the company is. So to maintain a portfolio with 20 to 30 cheapest stocks over time, it is necessary to sell the stocks that drop out of that range and buy the stocks that enter into that list. We do this once a year to minimize taxes and transaction fees. It would be done monthly in a non-taxable account. We implemented the strategy under the assumption that undervalued stocks eventually revert to their mean. We originally invested $30,000 into 30 different companies, so $1,000 per company in 2018. We sold a third of these holdings to acquire more Apple shares in August of 2020, bringing our acquires multiple holdings down to 24,000. We currently have about 37,000 in the strategy, and this strategy minimizes human error as it does not require the investor to make quantitative or qualitative analyses, but simply repeating an automated process once every year. And an example of like a stock that was a part of the strategy was GameStop. While the strategy requires you to hold stocks for 1 year, because of GameStop's drastic run-up, the portfolio managers decided to sell it early and capitalize on the gains. So overall, for 2.5 years, we earned about 669% of returns on GameStop. Next slide, and I can hand it over to Andrew.
Okay, so the big question is, how did we do? And since the beginning of 2020 to about mid-April, we earned a 21.61% return. That's pretty good, but at the same time, we underperformed our benchmark by about 1.5%. Our benchmark is 90% ACWI, which is a total world equity index, and about 10% AGG, which is a aggregate bond index. So we as managers are not just chasing absolute outperformance. We also want to generate alpha. Alpha is excess return. And while you can generate alpha through outperformance, you can also generate alpha through uncorrelated returns. And you can use things called asset pricing models to explain where those returns come from. Usually you have to take a certain sort of risk to generate returns. And so we can use an asset pricing model to determine where our returns came from. What risks did we take to explain our returns? Asset pricing models generally agree that there's a certain number of predefined risks that you can expose your portfolio to earn return. These risks are market risk, which is measured by beta, exposure to value stocks, which is measured by the HML factor, or high minus low. This is the small minus big, or S&B factor, which measures what your exposure to small cap stocks is, and the WML, or momentum factor, winners minus losers. And so you can use these factors to try and explain where those returns came from. You can see from back all the way from 2019 to, again, early 2021, most of our returns were generated through exposure to the market. A smaller subset of our returns were generated through exposure to value, which is a bit misleading because we actually had a negative loading on value. We have a lot of growth, as we explained earlier, about 20% of the portfolio. And so since we have a negative loading on value, and value out or underperformed, this actually contributed to our performance. That leaves us with about 3.6% in alpha, or return that can't be explained by taking some risk. It wasn't from the market, it wasn't from value stocks, it wasn't from momentum, and it wasn't from small cap stocks. So that's generally what investors want to see. Can you create return that can't be created anywhere else? And we would guess that a lot of this return was created from our hedge strategy and from our exposure to emerging markets. Over this period, the market returned about 45%, we returned about 39%. So while we underperformed, we actually performed better on a risk-adjusted basis. The Sharpe ratio is a measure of risk-adjusted performance. You're basically taking your return and dividing it by your volatility. And so while we underperformed by about 6%, we had a much higher risk-adjusted return, which is a good thing. And that leaves us with questions. I'm going to hand this off to you, and I'm going to look at the chat.
Oh, you have the usual.
So if anyone has a question online, they can type it in the chat here and we can answer it. And we'll take questions from the audience as well.
Who's going to handle that one? Yeah, here's the mic. So, could you just read the question?
Yeah, so we got a question from Jim Trolla asking what our thoughts are about the market this next year as we come out of the pandemic. That's a really good question. And I guess the academic answer would be we don't know, which is why we believe in buy and hold and our other strategies. On the other hand, You know, there's a lot of estimates saying the market and the economy are going to be booming. We're seeing high single-digit GDP growth. You know, and it's called the reopen trade. As everyone reopens, there's going to be a lot of sales. People have been saving a ton during the pandemic. They're going to want to spend that money. There's going to be a high increase in retail traffic. So we would guess that the market's going to do well, but you never know, and we wouldn't make a bet on it. So that's why we believe in our strategies and buy and hold in general.
Yields added inflation.
Oh, and inflation. Again, another question, another difficult one. So we're not economists. I'll tell you that, we're the first ones. But our hedge strategy, as we mentioned before, should protect us against inflation if there is some. When there is inflation, it pushes bond yields up, and our hedge strategy should perform very well should that happen.
National debt. He's added to it. Did you see that? National debt will surely impact us. I don't know if that's a question.
It's more of a statement.
Oh. So, you're right. Sean.
Small cap.
Yeah, we don't have much in micro cap, but in small cap, earlier I was talking about in our buy and hold asset classes, I believe we had 2 of our slivers of the pie that are allocated to the small cap and small cap value index.
That's also a strategy that we have wanted to visit and revisited earlier this year, and then kind of pivoted from that as we found PBL.
Which is small cap.
Small cap.
Danny, can you hear me?
Sorry, is that, yeah, I can hear you, yeah.
Okay, what did your team buy last year that fits in the micro cap?
Oh, we bought a very cool stock called Where Food Comes From, which is basically they work with like food labeling and like the certifications for food, and they have like some very serious connections and kind of contracts, and they're in a very like monopolized or oligopolized industry.
Thanks, really good. We got a question from Jim Bonnie Laxell, which is Jim and Bonnie Laxell. So are you in the low debt camp? Who wants to address that one? Past Eagle Fund managers have avoided securities with debt. Are you in that camp?
What do you got, Danny?
Danny.
Mr. Valley part of the presentation.
Danny, they're passing it to you.
Perfect. Yeah, I definitely have an answer for that. No, yeah. So I think that overall the question is very, like, it's very specific. I think that to look at the big picture is kind of what we like to do as a group and as managers. It depends on how the company's doing, or how the securities are, like how the securities are doing overall in comparison to the debt that they have, and if they have a plan to repay that debt within the foreseeable future.
Okay. So any more questions from the e-house on the chat?
We got one behind us.
Oh, go ahead.
Looking back on it, would you change anything you decided to do or anything that you'd like to think over in the future?
I guess we could all have something to say. I will say, funny enough, we decided to sell GameStop out of our acquires multiple strategy. And I think like the week before, it was valued at $100 more than we sold it for. And then the week after, it was valued at $100 more than we sold it for. So just unfortunate, but you know, uncontrollable there. But that would be the one thing that I would say.
So could you repeat the question so that?
Oh, I'm sorry.
I read it.
The question was just, do we regret anything or would we change anything that has happened in the recent past with the Eagle Fund?
And one thing Danny already mentioned was the microcap space. We were interested in investing in that earlier this year, but ended up investing in PBL, which is only a small cap. So I think the microcap space is something we're gonna revisit in the future because we think there's a lot of opportunity there because bigger companies can't typically invest in the microcap space because of institutional requirements. So we think there's an edge there to be had that we can earn more return.
I think another thing we regret is whenever we were looking at PBL, it was about like a 4 to 5 week process, and I think it might have increased by $20 a share by the time we actually bought it. So maybe pulling the trigger a little bit faster could be something else that could change.
It looks like we have another question from Jim Laxo. With interest rates at historic lows, what do you look for firms with more debt? If you believe interest rates are going to stay at historic lows, I guess would be the answer. We do have, due to our acquires multiple strategy, we do look for companies with a measure of cheapness. Those companies usually do have a lot of debt, and that's kind of where we get our exposure to those companies.
Yeah, also I would say, obviously we mentioned the timeline of how low, or like the timeline of those low interest rates. So if you have low interest rates right now, that doesn't necessarily guarantee low interest rates in the future, which can drastically increase like the company profits and the long-term debt that the firm has.
Questions in the house? Any more questions in the e-house? In the chat? No? Okay then. All righty. Well, thank you. Thank you very much. Very much appreciate you coming out to support the team here and to figure out. And so hopefully now if there are any other presentations, if you heard them, or I don't know, they get I don't know if they're going to have any. Are they having any musical concerts outside, or are they switching to inside? Yeah, I think that's a good idea. All righty, thank you very much. Have a great day. And see you later. All right. Okay, and stop.